In the weekend video, I'm going to review the markets. Again, we've got more confirmation as of Friday that the bottom is in for the stock market and possibly for the commodity markets, the CRB as well. So we got a 95% volume update here, and then we got one again on Friday. That's two of them in a row. Um, Intermediate rallies need to have a follow through day, and we got that in spades on Friday. So um, that's the next confirmation. With this also managed to close above the 10-day moving average. Um, the next hurdle is going to be to get through this resistance zone at 2600. Actually, I guess maybe the first resistance zone is going to be to get through this 2550 here, which was the February and the March bottom. We've got to get through that resistance zone first. I really don't think there's going to be much problem getting through that one, though. It's still very early in the intermediate cycle and very early in the daily cycle. And usually the first 15 to 20 days tend to be very powerful coming out of an intermediate bottom. And as you can see, we've already in 6 days, I think this is, we've already gained almost 200 points. So, um, following the normal template coming out of an intermediate bottom. And now I'm going to say again that I think everybody is going to be on the wrong, well, most everybody is going to be on the wrong side of the boat on this. I think most analysts assume that we are starting, a multi-month, maybe a year and a half, 2 year long bear market. Again, people are still are trapped in that mentality of 2009, expecting the next shoe to drop, and I am not in that camp. I do not think this is the beginning of a bear market, even though we did technically trigger um, the definition of a bear market. I do believe we hit minus 20% right here. But then we also did that in 2011 and 2016 at those two 4 year cycle lows as well. So let me widen this out to the to a longer term chart. All right, so as of right now, and I think this is going to hold, this is just a regression to the mean 4 year cycle low. And by that, I mean this is not going to be associated with a recession and a much longer, much deeper bear market. It's my opinion that that is not in the cards for us. Um, 4 year cycle lows that don't that aren't driven by a recession, they're just regression to the mean corrections, which just means that price gets a little too far above this long-term 200-week moving average, and then we need either a long sideways move to allow the average to catch up, which is kind of what happened here in 2016, or here in 2018 we just got stretched too far above the 200-week moving average, and one of two things either had to happen. We either had to morph into a parabolic move and a bubble that would collapse, and then we would get a recession and in a long multi-year bear market, or the market had to go sideways, similar to what it did here, or had to correct. And this one appears to have just corrected. This is the exact same pattern that played out in 1987. In 1987, we didn't have a recession during that correction either. So these 4 year, multi-year cycle lows that occur without a correction, they are regression corrections. That's what we had here, here, and what we're having here. We are not rolling over into recession. We're not even close. Employment is actually strong and getting stronger. We've added more manufacturing jobs in 2018 than we have in the last 20 years. So we aren't going into recession, and that would imply that this is a regression correction, no different than these two right here. nothing at all like what drove um, the bear market in 2009. So, the same people that tried to call a top here and the same people that tried to call a top here, those same people are calling, an end to the bull market, and they're looking for another one of these, and they're going to be wrong right here, just like they were, at these other regression corrections. And now this is something I'm watching to try and um, tell me whether or not to expect a retest of those lows sometime in March or April. Uh, the force with which the McClellan oscillator comes out of a four-year cycle low will usually define whether or not that is a four-year cycle low. This was the bottom in 2016, and you can see it was an extremely strong push out of that low. The McClellan oscillator went over 100. Um, the low that occurred 6 days ago, the McClellan oscillator was more oversold than the 2016, and we've rebounded from minus 110 to plus 70 in 6 days, in less than 2 weeks, and that's only happened a few times in history, and every one of them has led to gains, and big gains over the next year, gains in the magnitude of 20% or higher. So I'm going to watch this McClellan oscillator over the next week or two, and if we continue to surge higher and we get up here above 80, and especially if we can get up to 100, then I think I would make the call and say that we are done with the four-year cycle low. We're not going to get any kind of a significant retest of those December bottoms, and this correction has built the fuel, and actually sentiment. Retail trader sentiment, which is one measure, but retail trader sentiment was more negative at the low here in December than it was at the February low here. It was more negative than it was at the 2016 four-year cycle low, and it was even lower than it was at the bottom of the bear market in 2009. So the deeper the bearish sentiment, the further the rubber band gets stretched, the harder and further it can go in the opposite direction once the selling pressure gets released. That's just a lot of traders, and of course this isn't just retail traders. This is almost all analysts have jumped over into the bear market boat, and the same as they did here in 2016, and we saw what kind of rally that drove coming out of that four-year cycle low in 2016. We've got more fuel now coming out of this bottom than we did during this one. So you can see that this is how you set up kind of a slingshot move out of a four-year cycle low, and this is how we get to 10,000 on the NASDAQ and well above 10,000. We've just produced, we've gotten everybody on the wrong side of the boat, and that is the fuel for the next big rally. And like I said, I'm going to watch this over the next week or two and see if we can't get up here to above 80, maybe up here to 100. And if we do, then I think I'd make the call and say we're done with the four-year cycle low, and we're starting the next leg of the bull market, and this leg is going to take the NASDAQ to 10,000. It's going to produce a breakout in the semiconductor index, and the S&P is going to go above 3,000, and the Dow will ultimately go well above 30,000, probably above 40, and maybe above 50,000 before this long-term secular bull market is done, and we have at least 10 or 15 years to go yet. And if the four-year cycle low is finished in the stock market, then it should also be finished in the CRB. Sometimes these multi-year cycles sync together, and that may be why the stock market cycle came early, is because the bottom in the three-year cycle low in the CRB was due, and that may have just pulled the four-year cycle low into the stock market forward a year. to where they both have bottomed together. They did the same thing here in 2016. Both of those multi-year cycles bottomed together. Um, so I'm of the opinion that we probably got a bottom in the CRB as well. And this last 3-year cycle has been a basing uh, pattern. So I would suspect we're going to get a pretty strong rebound out of this bottom, and we'll break out above this high fairly early in the 3-year cycle, certainly within the first probably within the first year, and we will be starting an inflationary phase. And as I've noted before, inflation, the initial stages of inflation tend to be good for everything. Stocks rally, commodities rally, gold rallies, and gold has been rallying since August. And even though it's probably due to take a bit of a rest, it's just leading everything out of that bottom. The gold has been sniffing out the inflation that's coming for almost 5 months now, 4 or 5 months, and it's leading the rest of the sectors out of the bottom and into the initial stages of inflation. All right, so I'm going to make the call. I'm going to say before the end of 2019, and probably well before the end of 2019, we're going to come back up and test these highs, and we're going to make new highs, and the secular bull market will resume the same as it did out of the 2016 low. It took about 2 months, I guess, to get back up and test these highs. We had to churn there a bit. We'll probably do the same thing. I would imagine within 2 or 3 months we'll be back up here testing these highs. We'll churn a bit. It's not going to be easy to break right through there, but then when we do, the semiconductors are going to break out of that big 19-year basing pattern consolidation, and I think the semis will lead the rest of the market higher. And this time I think the biotech, which should be the driver of the next leg of this bull market, the old technology from the previous bull market, Apple, the FANG stocks, Apple, Google, Amazon, those were the leaders during this first part of this secular bull market. We need new leaders during the next 10 or 15 years, and I suspect that's going to come from a big part of it from biotech, nanotechnology, robotics. So I think we're going to get a new set of leaders rather than just running back to those old FANG stocks. They'll do fine, but I don't think they're going to lead the next 10 or 15 years of this bull market.